Wow, it's time for our last keynote. I can't believe it, especially today, the time just flew. And I'm really, really excited to have back here on stage Matthew Piepenburg. Had a chance to speak with him over the last couple of days. We've filmed a few interviews together as well. He hinted at a few things during the interview he's going to talk about, but I don't know the full extent of it. Based on what he said about a year ago, it was hugely popular, the content. And our YouTube video still gets a lot of views and a lot of comments. And I'm extremely excited to have him back here on stage to share his views on gold, the world, and where everything is headed. Matthew, thank you so much for joining us, and I appreciate it. Thank you so much, and take it away.
I assume it's just clicking. Okay, great. You got it. Well, thank you, Gal, for being here. It's tail end Charlie. You guys have had a couple of days of listening to a lot of folks, and our opinions and my opinions on gold. I know this is also a mining conference, and certainly, as I said last year, the gold price and the gold movement still matter because the production costs in mining and the gold price ratio is very important. And I still think the best days are obviously to come from mining. But I am going to talk a lot about gold. And it's interesting. My last presentation was a lot about the history and the cycles of gold and the silliness of policies. And that hasn't changed since 1789 or 1989 or certainly 2023. But I want to talk about gold in the context of two kind of competing aphorisms of English. In English, you know, the devil is in the details, which is absolutely true, but you also have to keep it simple, stupid, because we have 25 to 30 minutes to talk about a lot of things. And I want to make it resonate and make sense so there's more confidence in why we're all in this room. It's so many things pulling out of one simple theme, which I'll say till I think the rest of my life, and the way I look at markets and the way I look at precious metals and certainly monetary metals. You've got this debt reality, and then you've got the gold question and the gold reality. And I want to talk about all the things in 20 to 25 minutes, the strings that pull from that, whether it's trying to make bond markets interesting, understanding currency markets, understanding even oil markets, understanding debt markets, understanding central banks, understanding currency movements, understanding history, again, all in 25 minutes. But I think it can be done in a simple, stupid way that doesn't insult the details which are necessary in some form or another to really getting that confidence and that Überzeugung, that conviction that's necessary to play the long game. As Rick Rule said recently about silver, but I think it's absolutely true of all precious metals and certainly gold, it rewards infrequently but extravagantly for those that are speculating. For those who understand gold as wealth preservation, which is what we do at Matterhorn Asset Management, it just makes it that much more obvious why we're here and why we're all looking at gold together. So this is where I get to kind of do the arrogant I told you so, because I can't help myself. But this theme of de-dollarization, it seems to be the topic du jour and these turning points in history. But just over a year ago, this wasn't a topic at all. And yet, when these political events collide with monetary events and collide with geopolitical events, military events, and currency events, it was a watershed moment. As our colleague and advisor at Matterhorn Asset Management, Grant Williams, said right after the sanctions began early in March, is what we're seeing in March of 2022 is as big a watershed moment in the global markets, the currency markets, and the gold markets as we saw in August of 1971 when Richard Nixon welched on the 1944 Bretton Woods Agreement and the US gold standard. And again, this isn't just to say I told you so, but I wanted to read a few things that we wrote about within minutes, literally, of this chest-puffing moment of fun in the sun, this, I guess you call it Andy Warhol, 15 minutes of fame, when the West in general, and of course the US in particular, decided to freeze Russian FX reserves, take them off SWIFT transfers, and take off their excess to SDR. That certainly looked good in the headlines. We all remember the headlines, from the New York Times, the Washington Post, British papers, European papers, German papers. It was the West acting in cohesion against this bully, this Hitler 2.0, against George Washington 2.0. And I won't get into the politics of the debate on the war, but whatever you think of that, the policy reaction was, as we talked about yesterday, not just a shot in the foot, it was a shot in the head for a lot of reasons. And I'm not saying this 12 months after the fact. I want to say that we saw this literally from the day it started. And as we wrote back in March of 2022, freezing Russian reserves and kicking it out of the US dollar-denominated SWIFT system will simply give Putin more reason to find other markets and currencies to trade in. Think of the Chinese yuan or even gold, of which Russia and China, as Dominic reminded us this morning, have been quietly stockpiling. Such a move will destabilize the US dollar and hence just about everything else. As I finally concluded, Western sanctions against Russian energy will simply push Putin's oil exports, into the arms and currency of the Chinese. Again, that was in March of 2022. This whole debate, this vogue debate of whether that was a good or bad idea, I don't think is even a debate. It never really was. It was foreseeable from day one. And I'll go to the next slide, which is just, again, I won't spend a whole day quoting here, but this was just another 2 weeks later. And this goes to the theme that I see in so many financial and political policies since 2022, but certainly going back long before then. Myopia, short-sightedness, the need for clickbait, the need to look stronger than one really is, especially in the West, whether it's your currency, your military policies, your political agendas, your re-election campaigns, or even if you're Bernanke trying to get a Nobel Prize. You do what's popular in the short term, you ignore what's realistic in the long term because you're ignoring history, the history we talked about last year, you're ignoring the flow of monies, the cycles of debt, the reality of currency flows. So in March, again, just a couple weeks after that last article, de-dollarization coming full circle to bite the West. Again, the financial weapons unleashed by the West have dangerous consequences. The entire financial system of the last 4 decades, i.e. globalization, an artificial bond bull market, which Alistair talked about yesterday, basically 40 years of it, a manipulated QT disinflation policy, which is what Powell's been pursuing, just died, soon to be replaced by a multipolar, multi-currency, and new inflationary world. Again, this was when deflation was all the rage. This was when the dollar was all the rage. We were talking about inflation and more multi-currency system, all of which point toward a notable rise in the gold price. Last year, gold was in the 1600s. This week, it's hitting all-time highs. This was a year ago we saw this. This was not crystal ball thinking. This was not psychic powers. This was not tarot cards. It's understanding history, policy, and the reality of debt. I said Russia and soon China must now turn to swift alternatives, which will not only alter the global payment systems, but undermine the US dollar's global reserve status. Again, this was a year ago. I'm not here to puff chest or talk about my wisdom. We all saw this, not just me. And certainly all of us in our office, but all of us in this space who understood these cycles could see this coming. Unfortunately, whoever was making the decisions didn't. But just not to take full credit for this, it's worth remembering, whether you're left or right, President Obama said the same thing in 2015. He said, we cannot dictate the foreign, economic, and energy policies of every major power in the world. In order to even try to do that, we would have to sanction, for example, some of the world's largest banks. We'd have to cut off countries like China from the American financial system. And since they happen to be major purchasers of our debt, such actions could trigger severe disruptions in our own economy and, by the way, raise questions internationally about the dollar's role as the world's reserve currency. This was our president in 2015, long before Putin, long before this debatable war. And my question then, since then, is somewhere between 2015 and today, American common sense, leadership, and options took a nosedive. And I have to ask the question, again, not partisan, you know, obviously Obama was a Democrat because Biden was his vice president, but you have to ask yourself, who is really making the decisions in Washington, D.C.? Is it this guy who literally is asleep reading prompts for all his talking points and is lucky if he can make it 50 meters without falling over? Or is it these guys? And again, not to get into political debate about wars or about U.S. foreign policy or monetary policy, it's neither left, right, or center. It's fairly becoming obvious in my country, in the U.S., where I came from at least, that we call them neocons, but there are a lot of unelected officials in the Pentagon and the cabinet who make policy. And you have to wonder, was Biden the perfect, as Doug Casey said, happy idiot to put in place so that other unelected officials can make decisions about foreign policy and military policy that have massive financial ramifications and ripple effects? It's an important question to ask, whatever your politics. So, we saw it. President Obama saw it. Apparently, the Biden regime didn't see it. So how does de-dollarization look in real time? Well, this is the big debate that's made all the YouTube channels and all the pundits speaks. Is the dollar going to lose its world reserve status? Is it going to be replaced by the ruble or the yuan? My attitude, my opinion has always been consistent. That's not the real question. The US dollar comprises 60% of the reservoir of world currencies. It's 40% of all debt settlements are done in US dollars, whether that's to US banks or Chinese banks or European banks or European cash settlements or Asian cash settlements. So in terms of the world reserve currency, no, it's not going to be replaced by the ruble or the yuan tomorrow, next week, or next year. But that's not really the most important question. The US dollar as a global payment system, that has changing. There has been a hegemonic shift, a seismic shift in the role and the trust and the faith in the US dollar as a settlement of payments for transactions and for trades. And I've said this on many occasions, and I'll say it again today, keep it simple, stupid. This is where you get from the details, and we'll get into some of the details without getting boring, I hope, but there's over 14 trillion in US dollar-denominated debt in the world. Again, not just owed to the US, but trading in the world. It is the world reserve currency, a now weaponized world reserve currency. When you have trillions and trillions of dollars that have to be paid back from Europe or from Asia or South America or other countries or Japan, and you have a central banker in Washington who's raising rates at rapid speed, too fast, too much, far too late, we're talking 0 to 50 in a Porsche, 1 second. And because he did that, that made the dollar more expensive, and that made the satisfaction and the payment of those dollar-denominated debts far more painful for everyone else in the rest of the world. And so the world is breaking ranks from the US dollar. Again, breaking ranks from the US dollar does not mean the end of the US dollar as a world reserve currency, but it does mean a seismic shift, as we warned, and as Obama warned in 2015, and as we warned in 2022. And what does that look like? The BRICS, as we all know, are discussing a BRICS bank. 4 countries are now actively seeking, engaged in bilateral trade. 41 countries, excuse me, not 4. 41 countries, since the Putin sanctions, are now finding ways to trade outside of the US dollar in their goods and services. You've got a real movement towards the petro-yuan between Saudi Arabia and China. We all saw that infamous fist pump between the Crown Prince of Saudi Arabia and Biden when he crawled out of his car and barely made it to the red carpet. This was after Biden's administration had called the Crown Prince in Saudi Arabia a pariah state. So clearly the pariah state is not talking as much to the US as they are talking now to China and other countries about how they're going to sell and trade oil out of Saudi Arabia and other OPEC nations. Russia, Iran, and Venezuela are trading in yuan. The Russian finance minister is quietly establishing a gold-backed trade settlement currency. This is, again, something Alistair and Dominic talked about. This guy, Sergei Glasiev, we don't know everything transparently that's going on behind the scenes now in Russia, but we do know that they are looking to come up with a massive new trade settlement currency that will most likely, I can never guarantee anything until it makes the facts, but it's very likely that it's going to be a gold-backed trade settlement. Babakov, Glasiev, these are things that are going to have, as we talked about a year ago, and as Grant Williams and I talked about, and others have talked about, watershed effects in the US dollar's role, all the things that even Obama warned about in 2015. So, is this the last days for the petrodollar? Again, like I said, it's not the last days for the US dollar as a world reserve currency, nor is it the last days this week or this month of the US petrodollar. But there have been massive shifts, and I want us to look backwards at time as we did last year to think about this. In the 1970s, for those of us, most of us know, gold had an interesting period in the late 70s when it went from 175 an ounce in 1975 to over 800 an ounce in less than 5 years. There was a lot of reasons for that volatility and that movement in the oil price and in the gold price, but it has to be understood that it wasn't a foregone conclusion in the 1970s after Nixon welched the rest of the world on the gold-backed dollar that the US dollar would become the forced trading currency for all oil purchases internationally. It wasn't a foregone conclusion. Nixon knew it, and Volcker knew it, and the central planners in Washington, D.C., between the White House and the Eccles building knew it. And every day Volcker was coming into the office and asking about the gold price. And he was also worried about, since we've just taken away the chaperone and no one trusts our US Treasury and no one trusts our US dollar, all of which, by the way, sound familiar today, what was Volcker's response? Well, he raised interest rates by 15% very quickly. And the real yield on the US 10-year was positive 8%, not negative 3 to 4%, depending on how you look at CPI inflation in the 10-year yield. We have a negative US Treasury right now. Risk-free return is now return-free risk. Our US Treasury has been dumped on massive volumes throughout 2022, as we predicted, because the rest of the world is looking for liquidity, distrusting the Uncle Sam's IOU, and dumping treasuries at record amounts. So Powell cannot be Volcker to make the dollar look sexy for OPEC or Saudi Arabia, because he can't raise rates by 15% when you're looking at $31 trillion in public debt in the US. So the whole comparison to Powell and Volcker is actually an insult to math and common sense. But what happens when that US dollar and that US Treasury isn't as pretty as it used to be? When we can't even get past 6% without creating a string site of collapses in the bond markets globally and nationally. So the question now is Is Saudi Arabia and other countries looking at the petrodollar differently? I think it's a very interesting thing worth pondering. I think the reason you're seeing more conversations between China and Saudi Arabia than you are between the US and Saudi Arabia is history does change. Not all at once, but slowly and then suddenly. Again, it's just not the same treasury market. If you look at that great movement of gold on the left, the chart on the right is gold's movement now versus oil. It looks very familiar to the 1970s. We'll talk a little bit more about oil. Again, keep it simple, stupid. Don't want to dive into the details. We're seeing a very familiar chart pattern with gold and oil. We're seeing a lot of changes in the meantime in the gold space and in the oil space. In terms of bond markets, again, as warned in March of 2022, without tarot cards or a crystal ball, raising rates into a massive, unprecedented, historically, empirically obvious debt bubble, never seen before in history, created pain. It was yesterday's pain, and as we'll see, it's going to be tomorrow's and today's pain as well. But just looking back over the last year, we obviously have a very big debt problem in the US, the home of the world reserve currency and the home of the US Treasury, the most important IOU in the world. With an obvious debt problem, again, keep it simple, stupid. Debt to GDP in the US, 135, 130%, depending on how you look at, compared to where it was in the Volcker era of 35%. And then, of course, not just in the US is debt a problem or an addiction or a misunderstood reality and movement of markets. Global debt is clearly at the massive historical unprecedented level of 300 trillion plus right now and rising towards 400 trillion, I think at record pace. But debt is followed by one massive, when you have a debt crisis, it always creates cracks in the ice in every other area of the markets. And as we've just seen in the last year, another one, and then in March of this year, another one. But going back to 2019, which is probably one of the most important watershed moments in the bond markets, that barely made the headlines because it was so complex, the 2019 repo crisis, when the too big to fail banks that Bernanke got a Nobel Prize for helping to bail out didn't trust each other's collateral. That was the repo crisis of 2019 when you saw repo rates and lending rates between banks spike to unbelievable levels. That was followed in 2020 by a sovereign bond crash. The US Treasuries fell dramatically at the same time as stocks did when we had the COVID crisis of March 2020. Where the S&P went down negative 36%, I'm convinced that had the Fed not printed trillions in a matter of months, 4, 5, 6 trillion in a matter of months to reinflate the US stock market, it would have gone down far more than 36% in March 2020. But after that sovereign debt crisis in March 2020, we saw in the UK the gilt implosion in October of 2022. Again, should have been the headlines. Bond markets are boring. The ripple effects and what that means for Main Street or Hauptstrasse, not fully understood by the ganze Menge or the general public, but it is something boring that needs to be understood. I think more and more people are starting to understand that. You had that gilt crisis just a year ago. And then just as we rolled into 2023, barely getting used to the new year, we have a banking crisis in the US. And that's the latest bond market crack in the ice. When you raise rates into the debt bubble, things start to break. Repo markets, gilt markets, regional banks, and of course, US Treasuries. This to me wasn't hard to foresee if you follow the bond markets. Powell's impact on bonds, raising rates. When rates go up, bond prices go down. It's an inverse relation between yields and price. Well, Powell's impact in 2022 was basically every bond of every flavor took a nosedive last year. Absolutely destructive to the US bond market, from junk yields to investment grade of all levels and alphabet numbers. And then in 2022, US Treasuries fell faster than stocks. It was the first time in 60 years where Uncle Sam's IOU fell faster than stocks. Again, may not seem very sexy talking about bond market falls and what that means when a central banker decides to hike rates too fast, too soon, or too late, and too much. But it's not just the bond market or the credit markets with all the open signs of bleeding gut wounds from the repo markets to the bank crises. The bank crisis is just a symptom of the bond crisis. It was also a terrible year for stocks, but that risk parity portfolio that everyone's taught to swoon and kneel before, the 60-40, 70-30 stock bond portfolio, worst year for combined stocks and bonds, which in my father's and your father's and grandfather's era, bonds were supposed to protect, buffer the volatility and the risk and the volatility in the stock market. It was the worst year in the US for combined stock and bonds since 1871. Again, kind of a boring fact, but it's something to think about. That's just after the US Civil War. We haven't seen that type of combined bleeding in a long time. I think the most important one of the most important and ignored forces in supply and demand, natural or unnatural, is mean reversion. It's another thing we kind of keep out of sight, out of mind. Ausstein Augen, Ausstein Sinn, in a tailwind supported by synthetic liquidity and trillions of mouse-click money from the ECB to the Fed. But all markets revert to their mean, up or down. And we saw the worst stock and bond correlated asset fall last year. We also are running the risk of a mean reversion where we see a recession, which we'll talk about in a minute. And stocks, the bread and butter of the American wealth inequality, thanks to the central bank liquidity site, could fall very quickly, very fast, unless the central bank comes in like it did in March of 2020, to buoy it back up. We could easily see a typical mean reversion in a recession where the S&P is well below 3,000. This is not gloom and doom. It is mean reversion. It is basic math. It is the stuff we learn in business school. It's what every hedge fund analyst has to go through in their training or volatility courses in their analyst programs. But again, it doesn't make the New York Times or the Washington Post. It doesn't certainly make Biden's lips because it's way beyond his math and the math of just about anyone in the Congress or the Senate. Bond markets rising rates under today's pain. This is something that also, again, boring bond stuff, volatility in the 2-year futures market, the 2-year treasuries future market. Who looks at that? No one does. Don't blame you. Whether you're a bricklayer, a dentist, a doctor, a single parent, an entrepreneur, very few wake up in the morning, get on your Bloomberg and check out the volatility of the 2-year treasury. It's understood. But what isn't discussed, and should be, and I'm going to discuss with you now, is the volatility in that boring thing called the 2-year futures market. We had massive spreads, massive yield spikes we hadn't seen since 1987, 9/11 in 2001, or the great financial crisis in 2008. In other words, distrust in the credit markets at levels we had not seen in the great financial crisis of 2008, or in 9/11 when 2 buildings fell down in New York, or in the flash crash of 1987. The bond market doesn't trust each other. You couldn't get a bid or an ask. You couldn't get liquidity because there was too much price volatility in the futures contract. In that simple thing called the yield on the 2-year treasury, it moved in what the MIT grads call sigma events. And I'm certainly not going to stovepipe the math for you on that one because I don't even know it. But I know statistically those smart applied math PhDs, that's supposed to happen. Those type of sigma moves up or down, statistically once every 50 million years. That just happened a few weeks ago. Didn't make the headlines, wasn't discussed. Again, boring things. But what we're seeing is credit tightening at recessionary levels already. And in March 2023, investment grade bond issuance went from $180 billion the year before to $60 billion this year. Junk bonds went from $24 billion the year before to $5 billion. In other words, there's a tightening of credit. And this is something Alistair has talked about too. Credit tightening has a huge impact on bank lending, has a lot of implications. The real bottom line is that banks don't trust each other. They have their own list of the good guys and the bad guys, the ones they'll lend to and don't lend to, like we saw in 2019. They have the ones that they know are dying or need support or they won't trust. When you have distrust globally in credit markets and distrust among the banks themselves, that's not a good sign about the future of banking, which means it's not a good sign about the future of the economy or the loan quality or the faith in the IOUs of something as important as Uncle Sam's U.S. Treasury. And then, of course, the way I see it, any way we look at it, the recession question, any way we look at it, we're either in one, which I think we were already last year, but we redefined the definition of a recession midstream. We just changed the goalposts because politically it makes sense to say a recession is not a recession. But this Conference Board of Leading Economic Indicators, whenever it slips into negative territory for the last 60 years, it's always said it's because we're in a recession or right off the bow as a recession. You look at that, or the manufacturing ISM indicators, or you even look, and we'll talk about this too, of what we call backwardization in the futures market and the oil price. As you know, OPEC is contracting supply. It's cutting its production. That's normally sending oil prices up, shouldn't it? When you supply and demand, you contract supply, oil price should be ripping. If you haven't noticed in the last couple of days, there's been some interesting moves in the futures market and oil. The futures market has gone backward. It actually thinks the future price of oil is going down despite production cuts. Why? Because OPEC in the Middle East and Saudi Arabia see what the euro-dollar futures market, again, boring stuff, what they see, what doesn't make the headlines because it's so complex, so boring, the Einzelheiten, the details, is they're seeing a major recession in the US, which means less demand, less price pull for oil. Again, it's not gloom and doom. It's things like the euro-dollar market. It's things like the futures market. It's backwardization versus contango and all this kind of heavy-duty, hubbly-jubbly Wall Street talk that I spent so much time trying to decipher and translate to myself over the many years. But it still means, very simple, what we all feel is that something is off in the force. Something's off in the universe. and that what we're really talking about is historical volatility in the bond markets, historical changes in the currency markets, and a recession that will not be soft or even softish, in my opinion. And we'll have to, sadly, it's not something I want to be right about, we'll have to see where that goes in the next 6 to 8 months. Bond markets, rising rates, and unprecedented debt bubble equals tomorrow's commodity pleasures. This is where we go from stocks and bonds to that real asset sector called commodities, and of all different flavors. The graph on the left, lower yellow line, is just your standard 60-40 portfolio. Again, remember last year bonds and stocks did terribly? Well, the line above it is the commodity ETF, and the line above that is the energy ETF. Clearly, we're seeing a trend away from risk assets like stocks and bonds as we head towards a recession, and a more greater demand pull into energy and commodities. This other chart in the middle, again, I don't spend a lot of time on the charts. To me, they're just footnotes and talking points. But that middle chart was given to us by another of our advisors, Ronnie Sturfel at Incrementum, one of the most intelligent, modest, and understated geniuses in the space. He's the author of the In Gold We Trust report. I think he's quite an authority on cycles, and certainly on gold, and certainly on real assets. It's a very simple movement of up and down motions. That's the ratio of commodities to equities or stocks. When stocks are ripping, the most unloved thing on the planet, the most unloved sector is the commodity sector in general, not just precious metals, and the opportunity cost. So when you can make it with a tech stock or a rising tailwind, Fed-supported stock market, no one's looking at commodities. And yet, just think what we were all taught and that nobody did, from Nikkei to the NASDAQ bubble to the S&P crisis in 2008. Everyone's told to buy low and sell high, but nobody does it. They always think like lemmings or sheep, or whatever analogy you want to say. They move in groups. As they said in the Nikkei crash in 1989, before it lost 80% of its value, how can we get hurt if we're all crossing the street together? This security in numbers, this group think. It's always tomorrow's millionaires were always yesterday's contrarians. Not just crazy, kooky contrarians, but patient. Because again, it rewards infrequently, but extravagantly. You want to buy low, folks. Now, do you have the patience to wait a month, a year, 2 years, 3 years? Do you have to have that reward tomorrow to brag about at your golf tournament, or to your spouse, or to your friends? That's up to you. If you want to be myopic, you want the short-term gratification, go crazy, take on risk. But the cycles clearly say equities down, commodities, real assets up. But as Ronnie also pointed out in a tweet not long after the chart of the decade came out, that graph on the far right, don't need to get into the details, all it basically says is, just like with the Nikkei crash in '89, where was everybody? Not in cash. They were all long the Nikkei. And what happened to them all? They got blitzkrieged. Same thing in the S&P in 2008, the dot-com bubble, which made me unusually happy in 2000, 2001. I luckily got out of it, but it was obviously a bubble. But everyone was in it together, and nobody was in cash. Nobody was hedged. Nobody was protected. Their advisors were telling them this is the new normal. It's going to be fantastic. Of course, we all know what happened. Blood in the streets. No one was on the sidelines. No one was in cash equivalents. No one was in precious metals, and they got blistered. And so that graph on the far right is simply saying no one's seen the chart in the middle. You buy low, and you hold, and you wait, and you have conviction to hold and wait through the pain. So then we get into the question of what will the Fed do? Will there be more QE, more QT? Will there be more liquidity? Again, discussed so many times, but it's very simple to me. Rising rates into a debt bubble equals more fake liquidity. It is unvermeidlich. It's inevitable. It's unwiderstehlich. It's irresistible, and it's also essential. It's erforderlich. When the US dollar is too strong for the world, we see de-dollarization, which we talked about. Your dollar is too expensive. You've made it too expensive. We're breaking ranks. We're making new alliances. We're looking for new currencies. In the US, when the dollar is too strong and rates are hiked up by a very Volcker-esque central banker like Powell, that makes it too expensive for Uncle Sam himself to pay his own incredibly embarrassing bar tab of just living on debt and IOU after IOU. So look at the interest on the US debt is now $800 billion just to pay the interest expense. That is more. That's over 125% of US tax receipts. So it's not coming from tax receipts. GDP, the Fed, Atlanta Fed now forecasts GDP has gone down by 1.5% over the last 60 days. So we're not getting it through manufacturing because the American dream was outsourced to China way back in 2000s, early 2000s. You can thank Bill Clinton and the world, WTO, all that. We get into politics, left or right. We sold the American dream to China. Manufacturing is in China. GDP was sent to China because it was cheaper labor. It made the CEOs of our publicly traded companies who were paid by the share price richer, but we fired a lot of people who live in Tennessee, Michigan, and Ohio in the Rust Belt because all their jobs went to cheaper labor in Asia and sometimes in Central America. But the point is, tax receipts aren't going to save us, and GDP isn't going to save us. It's not going to be economic growth. So who's going to buy those U.S. treasuries that we live on? It is the lifeblood of the U.S. survival story. It is about debt. What's the solution to a debt problem? Thanks to the Bernanke Nobel Prize-winning central bankers. Hey, solve a debt problem with more debt. It's brilliant. Boy, he must have gone to Harvard. He must have gone to Wharton. He must have gone to MIT. He deserves a Nobel Prize because he came with the idea of solving a debt problem with more debt. Hey, and if we don't have the money to pay for that debt, let's just go down into the basement and counterfeit it and print it out of nowhere. It's not attached to gold. It has no chaperone. And by the way, it's even better. It's legal. And they're going to prop me up for a Nobel Prize so we can give you all confidence that it must be really smart. But, you know, we're running twin budget deficits and trade deficits. We're looking at probably at least $33 trillion in public government debt by the end of this year. And again, no tax receipts. And at the same time, we're witnessing de-dollarization at a rapid, irrevocable pace. I think it's a problem not just for the world and not just for Uncle Sam, it's a problem for investors too. So I see, as Luke Groman and many others, and Ronnie and I, and we talk about this all the time, what's next? Who's going to be this? If there's no natural demand for our IOUs, the most important IOU in the world, where's it going to come from? I think more liquidity is a matter of survival, not debate. Again, my very strong, I hope to say, informed opinion that the U.S. can't afford tanking U.S. Treasuries, because if U.S. Treasuries tank, what happens to yields? They go up. Remember? Simple, stupid. If you take anything away from this, bond price and yields are inverse correlation. If no one's buying Uncle Sam's bonds, the yields go up. And those yields are correlated to interest rates. So again, the Fed doesn't control interest rates in a vacuum. Powell is not the magical man of Oz who has all power. He can raise the Fed funds rate, but it's the bond market, even in an unnatural bond market like ours, it is the bond market that gets the last laugh. If no one buys those Uncle Sam treasuries, if no one buys those debt instruments, they go down in price. And then the yields go up in price, which means interest rates go up. Interest rate is the cost of debt. We survive on debt. If those interest rates become too high, that $800 billion interest rate expense annually by Uncle Sam goes to $1 trillion, $1.5 trillion. It gets more and more unsustainable. And then there's the risk of a default, which I personally believe, despite all the debt ceiling conversations, default is political suicide. It's not going to happen. It's not going to happen. But the only option for me, you know, what do you do? When, again, the US dollar was once so respected and so powerful because with the help of Russia, we helped beat fascism in Europe. We helped bring democracy to the West. We were the flag on Iwo Jima. We were the great country. We were America. And we had all the stories in the black and white newsreels of the American dream and the cars up and down the streets of Santa Monica and Hollywood and this great story, the story that I believe in, the American dream that I grew up in. But it's not the same America. It's not the same IOU, thanks to Nixon and others who welched on that IOU and welched on that dollar because it's chaperoned by nothing. And that U.S. Treasury, which is the most important bond in the world because it gives you risk-free return. But when you measure it against inflation, which Powell is allegedly trying to fight, you're actually getting no return for the U.S. Treasury. You're getting a negative return. If you're in China or Japan or in Europe and you're an ally of the United States, I always say, with friends like the U.S., who needs enemies? Because they'll give you an IOU and promise you a negative return. In effect, when a bond is a negative return, in effect, that is constructively, literally, a defaulting bond. If you pay for a U.S. Treasury, you're guaranteed a negative return when adjusted for inflation. At certain points, nominally or in real terms, you were getting hosed. And China and Russia, before the war, were getting a little tired of that, as was Venezuela, Brazil, India, not to mention Argentina, Lebanon, Yugoslavia. Other countries that have been importing our inflation for decades are looking for an excuse to get away from it. But it's all tied together. But that risk-free return is literally, not doom and gloom, return-free risk. And there are implications when the U.S. Treasury is return-free risk. So again, I see an unloved U.S. Treasury. The only one who's going to buy it is the Fed's central, the mouse clicker, the money clicker. So the inflation debate to me is really not a debate. It's in the cycle. Everyone talks about inflation, deflation. Yes, Powell's rate hikes are deflationary. When you make it very expensive to own money or to borrow money, it slows things down. You crush demand rather than focus on supply. What a brilliant idea. I'm going to solve the inflation problem by putting the economy in rubble. That's how I'm going to do it. It's not by raising rates like Volcker, which he can't do. He's basically trying to engineer a softish recession and stovepipe that in his mind and not think about all the consequences for the rest of the world and for the Main Street Americans. So, you know, recessions are and will be deflationary. Powell's rate hikes are deflationary. But unfortunately for Powell, as I say here, his hawkish and deflationary days are numbers. As I said, at these debt levels, mathematically, Powell cannot be Volcker. I'll say that over and over. When Volcker was in the Fed, US debt was 800 billion, not 31, 32, 33 trillion. So he could play with interest rates in an aggressive way. And the debt to GDP ratio was very different then. So it is not even worth comparing Powell to Volcker. To me, it's not even a debate. And yes, Powell's recessionary, or excuse me, fighting inflationary policies, which are causing recession, can be recessionary, and they can certainly be deflationary. If you look at the CPI scale, it was at 9% last June. It's down below 6, maybe 5%, assuming you believe the CPI scale, which whether it's right or wrong, the Fed is never honest, but it's always right because it is the official purveyor and producer of the Bureau of Labor Statistics inflation number. But the real inflation, everyone on Wall Street knows, is at least double what it's reported. So Powell is fighting inflation, but he's actually enjoying inflation because inflation helps Powell inflate away our debt. I think that's the real story. But again, to me, and this again, debatable, supply shocks matter, trade agreements matter, boycotts matter, trade wars matter, Trump's policies matter, Biden's policies matter. But to me, inflation is about the broad money supply. And if you look at that chart on the right, M2 money supply, 14 trillion increase, M3 money supply up 500% since the great financial crisis. When you spit that much money into the system, it's like adding, I joke, I live in Bordeaux, you take a swimming pool full of water to my glass of good wine, that flavor of that wine is going to lose all of its joy. And the purchasing power of the currency, when you add that much liquidity from a money clicker, ruins the inherent purchasing power, which is inherently inflationary. So I think Powell will have no choice but to debase and pivot, and that's ultimately inflationary. So you'll see recessionary or deflationary cycles in an inflationary trend. Putting it all together, then we get to gold. Again, everyone here who's studied gold and thought about gold in the context of history or current events knows that it's really not about gold doing anything exceptional. Gold doesn't do anything. It just sits there while currencies kill themselves, shoot themselves, while politicians ruin the purchasing power of the euro, of the British pound sterling, of the US dollar, of the peso. So this famous chart on the left, don't need to blow it up, it just shows a simple trend. Since Nixon welched and took away the chaperones, so the guys like Nixon and everyone else who followed could stay elected by putting everything on a credit card and promising miracle solutions anytime there was a hiccup in the markets or the economy, and especially right around election season, start spending more to buy votes, buy popularity, put it on a national credit card, send it to my kids or my generation to deal with the problem later, and then blame that on Putin, COVID, or something else. It's very simple. We've just killed our currencies. And gold only rises because currencies are dying. I always joke I'm an insurance salesman. Gold's insurance for dying currencies. I'm selling, house insurance or flood insurance to homes that are on the riverbed right now. So the world reserve currency, that is, by the way, the Swiss franc, the euro, the US dollar, and the British pound. Since 1971, they've all lost greater than 98% of their purchasing power when measured against a milligram of gold. That's not a gold bug apology. That's not trying to be gloom and doom. That's just facts. We can look at different statistical moments in the gold price between 2000 or between 1971 or 75 and 80 or 2011 and 2016, but the trend is clear. Fiat currencies have lost their credibility and their punch and their wine flavor, and so gold just sits there and gets more valuable on a relative basis. Now, 2022, US dollar gold, so disappointing. Look at that chart. The chart on the left is gold last year, in the 1600s. This year it's hitting all-time highs. I said throughout, we all said throughout, those who watch gold, that the US dollar, I hate to use the word, its strength was transitory. It was unsustainable. Those rising rates, those policies were unsustainable. The US dollar realized that it shot itself in the foot by making the US Treasury too expensive. It didn't make more investors buy it. It made more people sell it, more foreigners dump it. And so, I won't get into all the reasons how the US dollar is, but now the US dollar is 11% weaker than it was a year ago. And since this year, it's already on a trend south, as predicted. Again, not with a crystal ball, just common sense about debt cycles. But last year, when the gold was hitting major lows, not all-time lows, major lows in the recent year, if you looked at gold in other charts and other currencies that weren't the world reserve currency, that weren't the weaponized currency, that didn't have the power to print and to export their inflation, they were all hitting highs. The yen, the British pound sterling, the euro, they weren't making headlines about why the gold price wasn't successful. It was just the US dollar. And it was just the US gold price, which is an important gold price. But that was because the US dollar was temporarily strong. And I see it getting weaker. Again, why? Because the world reserve currency status is a status with really no status. Because there is de-dollarization. Again, not the end of the world, not the end of the world reserve currency status, but there's a clear trend away from the US dollar and therefore US demand. If the petrodollar makes a seismic or even partial shift, that means less dollar demand. That means a weaker dollar. Of course, U.S. markets and the U.S. bond markets require more synthetic liquidity to keep bond yields under control. That means more money printing. That means a weaker U.S. dollar. So the gold price in U.S. dollars is only going to go further up and right, not in a straight line. There can be pullbacks, of course, especially if there's a market hiccup of major proportions. Yes, gold can be sympathetic in the short term, but if you look at every event where there's a market crisis, gold goes down for a very short period of time, and then it reaches all new highs afterwards. So there's a lot of forces in play that I don't think are gold bug apologies, gold bug defenses. It's just cycles, common sense, and currency issues. Putting it all together again, I have said the world is dumping U.S. Treasuries, and what are the central banks, in particular the central banks in the East, to the comments that were made by Dominic this morning, there is a slow but steady, not covert, but very long-term thinking. Countries like China, countries like Russia are used to austerity, they're used to authority, they're patient, they can suffer more than Americans with their jet skis and their Porsches and their 2 homes and their weekends in the Hamptons and Nantucket. It's a soft culture. We've been, since my birth, it's been the best of times, but we've been living on borrowed time and on borrowed money and on debt, whether it's at the household level, the corporate level, or at the government level. So the rest of the world, especially in the East, are quietly selling U.S. Treasuries, and what are they buying at record levels? Physical gold. Because I do agree with Dominic and everyone else in there that follows these views and these gold movements, the physical movement of gold, which isn't always reported every day in the Washington Post, the Times Again, or the Wall Street Journal. The Chinese and the Russians are playing a longer game. They're playing chess. Well, Biden, to the extent he can still see the checkers board, is playing checkers. And his advisors are playing checkers. And they're playing checkers with our futures and our currencies, and we are going to see a shift to the East. I don't think it's going to be Bitcoin that's going to solve the problem. I'm sorry. I'm not here to criticize Bitcoin, and I hope that those of you who invest in digitals get the last laugh, because Bitcoin is certainly more intelligent than fiat dollars as an alternative currency, and certainly better than a fiat dollar, euro, or yuan. But I don't think the rest of the world's going to be buying Bitcoin in their central banks when the new world order, whatever that means, the new reset, the new restructuring of trade settlements, the new restructuring of currencies. I don't think China and Russia are going to resort to Bitcoin. And if anything, it's only because maybe Bitcoin is too smart. It's certainly too smart for the US dollar and the US politicians. And I think that's an existential threat to a country like the US to see Bitcoin become too powerful. Because central bank digital currency has many motives. I won't get into all of them today. But one of them is to make Bitcoin less and less popular, less and less powerful. Again, I hope that central bank digital currency doesn't get the last laugh, but it is a threat to Bitcoin. It's also a threat to all of us for different reasons. But again, that chart on the bottom, not going to get into the percentage moves and the dates and the times, but that little boring golden line through the middle is the price volatility of gold. The blue lines up and down, up 20, 30, 40% in a matter of days is the price volatility of Bitcoin. If you're trying to create a new currency system, a new trading system, a new trading alliance, whether it's with the BRICS or whether it's in Eurasia or whether it's in South America, or sadly, in Central America too, Bitcoin's not going to give you the price stability that you need to organize that new system. But it doesn't mean Bitcoin can't make a speculator or a trader wealthy. So I'm not here to make fun of Bitcoin. I'm just trying to say in terms of the trade alliances I see and the trends, physical gold is going to get the last laugh. The future, I'm going to try and keep this quick. This is just getting away from the complex math and the volatility numbers and the politics, and just look at something as simple as someone who wasn't a politician, wasn't a central banker, wasn't running for office, wasn't a pundit on gold or markets. But what he said is the first panacea of mismanaged nation is inflation of the currency. The second is war. Both bring temporary prosperity. Both bring a permanent ruin. But both are the refuge of political and economic opportunists. That is exactly where we are today. I don't care whether you're in Europe or the US, in particular in the US. What's the easiest way to get elected? Promise more than you can deliver, pay for that with money printed out of nowhere, blame it on an extraneous event, debase your currency. But eventually that debasement kills the system or threatens the system. And as I've said in many articles, and I'll say it again here, and I said in interviews this morning, when a government is faced between seeing its system and its power threatened or its currency debased, it will always choose to debase and destroy the currency rather than destroy their own power. They will always see the currency die. The currency is always the last bubble to pop. And in case you think I'm making this up, where are we today? Where are we today? Inflation, currency, debasement, and war. US CPI inflation, not reported accurately by the Bureau of Labor Statistics. That's an open secret. That's not conspiracy theory. It's at least twice as what we reported as. Currency debasement, that's the money supply. Bernanke said there'd be short-term QE back in 2010. It'd be short-term with no consequence. He's destroyed the inherent purchasing power of the dollar, and the money supplies are ripping at 500%. In terms of war, just in the last few years, we all know Iraq, Libya, Syria, Afghanistan, and now Ukraine. Our war on Ukrainian soil, whether you're for or against the war, lots and lots of men and women are dying, civilians and military, so that we can prove how strong we are. I don't care what you think of Zelensky or Putin. I think it's a travesty. I think it's a man-made, American-made travesty. That's my report. That's it. It's a lot in there, but hopefully that made some sense to you guys. Thanks again for having me here.
Wonderful, Matthew. That was extensive.
Yes, extensive. Yeah.
Do we have any questions? We'll ask if you have any questions, actually, for the last couple minutes. So, Rodney, I hear you.
Correct me if I'm wrong, Matthew, but as early as 2019, we started seeing an inverse yield curve.
Yep.
Do you think, in your opinion, do you think policymakers in the Fed ignored it and or engineered a softer delay to push it into the future?
Great question. I mean, a couple things. I don't think they ignored it among themselves. I think it wasn't the topic du jour at the FOMC meetings or the Brookings Institute or in, Jackson Hole. It certainly wasn't the typical question from the press, the press conferences in front of Biden. So I think it was deliberately downplayed. This is really how they do things. It's really, I think, what's interesting in the fourth estate in the U.S., the media, which is corporate owned. And again, this is not left or right. We're in Europe. We remember the 30s here. Mussolini, Franco, Hitler. What was Mussolini's definition of fascism? The perfect marriage of corporations and government. And I think the media is one of those corporations. The media, the fourth estate, which Thomas Jefferson, Thomas Paine, this was what was going to make America great, this independent media. You have to go to Substack now or certain channels on YouTube just to get different opinions. They could be crazy, but that's where we have to go now. I think there was a very deliberate policy just to ignore Austin Augen, Austin Sin, out of sight, out of mind, ignore these hard facts. And what's interesting about the yield curve too is that yes, usually when it inverts, that's a sign of a recession coming. It's a leading indicator. When it goes from an inversion back to a normal stance, that's usually when you've got the last few hours to look for a lifeboat. But again, I think there are so many signs of recession. The yield curve is almost passé now, and the volatility in the short end of the yield curve is fascinating. It's unprecedented. What we saw in the 4-week T-bill, we've never seen before in history, ever. It's not even on the news. No one's talking about boring yields. Sorry, yeah. Mm-hmm.
So you gave us, my name is Mark, I'm from the Netherlands.
Mm-hmm.
You gave us an analysis of the current situation.
Mm-hmm.
I will record it.
Yeah.
You gave us an analysis of the current situation. Mm-hmm. Can you give us some thoughts about the situation of this world in 10 years from now?
I'm a cynic, so I'm the worst person to have at a party, and I could be, and I hope I'm wrong. And by the way, I always say, look, it's an important question. Everything that I say is from conviction. I'm not trying to be a know-it-all. I think you could challenge all my assumptions here. But luckily, I think math is more objective than even opinions. And the math, I try to be as detailed and honest as I can. To your question about the next 10 years, to make it simple, it's not going to be as enjoyable for the top 10% as it was in the last 10 years. You have to understand, this wealth inequality that was created by men like Bernanke and Powell and women like Yellen, I'm the beneficiary of that asset bubble. I'm the beneficiary. I'm the top 10, top 1%. I'm not saying that with arrogance. It is dangerous for me and for any of us in this room who think it's good to see an asset bubble like the one we saw in the US or Europe, because the wealth inequality creates social unrest. It creates destabilization. It creates distrust in politics. Distrust in politics in a debt-soaked nation with wealth inequality historically leads to less personal liberties and more extreme control from the left or right, historically. So I see a very jaded, splintered population, as they should be. They don't understand yield curves and they don't understand Fed policy. They just know that that guy's got a lot more than me. I get on a bus every day to go to work. I can't make my rent, and that's not fair. And I'm going to blame somebody. It's going to be identity politics. It's going to be racial. It's going to be sexual, transgender, black, white. It's so much Zerrissenheit in our culture right now. And I think also in Europe, certainly in Paris, and I spent a lot of time in France. We see it. These aren't just bogus headlines. There's a fracturing of society. These are the immeasurable, unquantifiable things. And to go to your question about the next 10 years, I see social unrest. I see more lies like CBDC. I see the omission of facts from the news, because lies of omission are the way they do it. It's what's not reported in the news. It's what's not debated. I would love to be in a debate with a politician. Let them walk all over me, but at least bring it to the public. Let's talk about our debt. Let's talk about our central bank policy. Let's ask why Bernanke got a Nobel Prize. Let's ask why we have the highest wealth inequality in our history. Let's ask if that's good for the rich as well as for the poor. Why is racial politics taking over financial politics? Why are we not getting better candidates to run for office on the left or the right? Why do we not have sound money? These things can be debated. It doesn't have to be a Matt Piepenburg or Egon von Greyer's view or an Alistair view or a Dominic view. Let's have these things debated like we used to in the 70s and 80s when William Buckley and Gore Vidal, brilliant men of different opinions, could actually talk without insulting each other or being castigated as fascist, racist, or conspiracy theorists. That lack of transparency, that lack of intelligent, informed debate has been replaced by emotional debate, propaganda, and dishonesty. So that means the next 10 years won't be good for markets, won't be good for society, won't be good for individual rights, and they will, in my opinion, roll out a version of central bank digital currency like a Trojan horse, but they're going to wait like they do whenever there's a crisis. They need a crisis to say, hey, if we had central bank digital currency, SVB, First Republic, Credit Suisse, we could have saved this with faster, transparent liquidity, payment systems. They won't tell you about all the other risks. But this is politics 101. I'm sorry, that's my jaded view. The optimistic view is there's a renaissance of thinking. There's a new, age of Aquarius. People get tired of being lied to. They get tired of fake money. They get tired of fake politics, fake news, left or right, and they start getting along and cooperating in society. Like John Nash, the famous Princeton grad, who said the best way to get through a problem is to cooperate. America does everything it can to not cooperate, but to control.
And on that bombshell.
Yeah. Sorry, not optimistic.
Matthew, thank you so much.
Okay.
Absolutely fantastic.
Thank you.
This is the end. This is the end of day 2. This has been the most successful Deutsche Goldmesse yet. And looking into in the room, I might have to rebrand it as well. This might be the International Goldmesse next year. Just kidding. But we have a lot of international guests here. We've attracted an amazing audience. We've had fantastic companies. We've heard from 26 companies, 6 fantastic keynote speakers, amazing panelists, and we had you, the investors, here as well, from the Netherlands, Sweden, Finland, Switzerland. Didn't have Austria, I think, but everywhere else. The UK. If I forgot anybody, I apologize. It's been a tremendous, tremendous success for us. I hope it was super informative for you. As I said, we had the most one-on-one meetings, I think, on a per-company basis this time. The companies are loving this. They love to come out. They want to tell their stories. We hope you get a lot out of it. I hope you made use of it. The numbers show that a lot of you did, which is awesome. Thank you so much for joining us. We will be back. There might be a slide in a second, but November 24th and 25th here in Frankfurt again, same place, pretty much the same time. And now we have a cocktail reception outside. I heard the class is already dinging. I was a bit mad that I didn't have one, but please enjoy it. Have a good time. Thank you so much for coming.